Good morning, everybody, and thank you all for joining us for today's webinar titled Listing Your Business in Uncertain Times. Thank you all for joining us. Thank you for your time. I'm sure we'll have more people joining the webinar as we go along. Just as a very high level, the objective of the webinar is really to profile South African capital markets as a funding source, but more importantly, to provide you with insights when considering the public market. And for that, we're going to have an advisor view and an investor view. We do have a highly esteemed and experienced panelists. They're all going to give you their insights, but we also want to give you an opportunity to ask any questions related to your company growth. So as we go through the webinar, please submit your Q&A. Don't wait to the very last moment. Submit your Q&A, and at the end of the session, we are going to go into the facilitated Q&A session. So really, my intention for today is to provide you with a robust discussion, ask a lot of questions. And before we do that, I want to mention a couple of JSE stats. From a JSE perspective, capital raising year to date, we have facilitated, or companies rather, have raised 50 billion rand. If you compare that to last year, we had raised 35 billion rand. And of course, looking at this year, 64% was raised throughout the lockdown and the pandemic. So again, this illustrates the benefits of being listed on the JSE, the improved access to capital via the secondary market, and this is pretty much in line with global trends. A number of the companies globally are strengthening their balance sheet, raising capital, and taking or making use of the opportunities that they see. Some of our local players that have raised capital, we have got Curo Holdings, which raised 1.5 billion rand. Foschini Group raised approximately 4 billion rand. Sun International, City Lodge, 1.2 billion rand. And probably the biggest one for the year has been during the lockdown recently, has been the Hammerson, which has been 12 billion rand that has been raised. Then from a listing perspective, year to date, we have had 4 listings. Most of those listings have been as a result of corporate actions, which essentially means that companies are unbundling, carving out assets and listing them as separate entities. This is again in line with global IPO market and sentiment. Global IPOs have been muted, and South Africa has certainly not been immune to that. Now, many of you, as we're going to go into the panel discussion, we are going to be talking about listing on the JSE. You may also ask yourself, what are the admission criteria to get listed on the exchange? And for that, I thought I'd give you a brief summary of what the requirements are from a JSE's listing admission criteria perspective. So just very briefly, in terms of Altex, you need to have a share capital of 2 million rand. When you compare that to the main board, it is 50 million rand. There's no profit before tax on the Altex, but on the main board, you need 15 million profit before tax. So that's 15. On the Altex, we do list entrepreneurial businesses, and for that, we require 1 year of audited financials and at least 1 year forecast and projections going forward. And for the main board, there we attract the more stable and well-established companies, and we look at a 3-year audited financial and track record. And probably one of the most important points is that, when listing on the JSE, you will have to sell part of your equity to external shareholders. On the Altex, that percentage is 10%, and on the main board, it's at 20%. And of course, this is very important to ensure that you've got liquidity in your stock. So that spread would be essentially held in the public hands. And again, as owner-managed business, this is often very difficult to not meet, but really to kind of let go of that company to sell into the listed market. But it really is important to ensure that investors can buy in. There's relevant liquidity, but they can buy and sell your respective stocks. So just to introduce some of the speakers for today, first of all, we've got Willie Honeyball. He's a director of PSG Capital. He has been at PSG Capital for the past 9 years. Prior to that, he was based in London for 8 years. We had worked in roles at investment banks, focusing on fund arbitrage, private equity, hedge fund sales. Since joining PSG Capital, he has been involved in numerous capital raisings and listings, bond issuances, mergers and acquisitions, and BEE transactions. Secondly, we've got Sam Makarossi, who is the head of deals and origination at the JSE. His role focuses on identifying new streams of growth and diversification in SMEs and infrastructure industries. Sam is a seasoned financial services executive with close to 20 years experience in corporate finance, private equity, and the bond markets. He has successfully executed corporate finance and private equity transactions worth 35 billion rand. Thirdly, we've got Keith McLachlan. Keith has built and still runs small cap concider. He has a career approaching 2 decades focusing on investing in off-radar stocks, initially focusing on JSE small cap markets. He established the small mid-cap research function at Standard Bank CIB before becoming a rated analyst at Tebe Securities, servicing the major asset managers. Nearly 7 years ago, he moved across to Alpha Wealth, where he built and runs Alpha Prime Small and Mid-Cap Fund, along with a range of on and offshore portfolios, and occasionally handles the odd corporate finance projects. And then we've got Chris Reddy, who's a portfolio manager from Muzzy Asset Management. Chris has 15 years of experience spanning across equities, fixed income, corporate finance, and strategy consulting. He is currently a portfolio manager in Muzzy Asset Management, and he manages the property, Sharia equity, and fixed income funds. Prior to Muzzy, he was part of Citibank, City Africa corporate finance team that covered the origination and structuring and execution of transactions in Africa. And lastly, I'm going to be your moderator for today. I work for the JSE. I'm a business development manager. I've worked for the JSE for 13 years, and majority of my time has been spent focusing on origination of equity listings. And as a primary markets division within the JSE, we focus on the origination across the 3 asset classes, being equity, debt, structured products, and fixed income. But of course, that is debt. And of course, new product creation. So just to introduce how we're going to run this panel discussion and this webinar is that we've got 4 key themes, and those themes are from startup to scale up to IPO and beyond. Secondly, what are the key considerations for a successful listings? Where do you find the capital? What is the time that you need to get to the market? And most importantly, what are the strategic consideration when listing on the JSE? We will also look at some key learnings from previous listings, and also what do investors look for in newly listed companies and IPOs. Then we are also fortunate to have Andries, who's the Chief Executive Officer of Afrimat, who's also going to be joining us, also telling us a little bit more about his story, his company, the rationale for listing his business on the JSE, what his key considerations were, and also successes since he's been listed on the JSE. And lastly is that Q&A facilitated session by Sam. So before we go into the discussions, I thought that we can get our audience involved, and I would like to ask Sihle to run the first poll. And the question there that we're going to ask is, what is the main reason that you would consider listing your business on the JSE? And I'm sure that that's going to come up shortly. You will have an option of choosing from access to capital, increased profile, facilitates private equity, shareholder exit, or the use of your transaction currency for future acquisitions. And Sihle, do we have the poll running? All right, Sihle, when those results come in, if I can ask you to please let us know, and I'm sure it will be visible on the screen as well. Mustari. All right, so we're just getting those polls in. And here we go. We've got 70% that say it's access to capital, B, increased profile 10%, and 10% to facilitate private equity or shareholder exits, or the use of currency for your shareholder, for your future acquisitions. So it looks like access to capital is definitely the main reason why many of you would tap or list on the local equity markets. So for our first question, and for our first theme is from startup to scale up to IPO and beyond. And for this, I would like to get Willie to kick us off. And I'm going to ask you, Willie, in your experience, and please give us examples where you can. How do you scale a private, or how do you scale in the private versus the listed markets?
Well, thank you, Patricia, and just a welcome from my side also to all the webinar participants. I think maybe if we can just separated to private capital pools and listed capital pools. If you look at private capital pools, it's typically less liquid. The valuations or the multiples that one can achieve in capital raising rounds are typically lower. And there are fewer participants in that space of the capital market. However, when you compare it to a listed market, there are many more participants. The market is much more liquid. You typically achieve higher valuations in a listed space, and your timelines can be a lot quicker to execute. Now, in the unlisted space, companies can grow. A lot of companies have demonstrated that to us over the years, but a company in its life cycle may have been supported through a strategic or anchor shareholder, and to continue to scale up and grow, that anchor shareholder may have run out of capacity to further support further rounds of capital, or it may be a case that shareholder may want to take some money off the table. Now, in a scenario like that, is your growth may be slower going forward, or you may want to consider maybe bringing another private shareholder on board, or you can access the listed capital markets. Now, when you go that route, you can obviously evaluate the opportunity in your life cycle where you are, and is it a time for you to go to the capital markets where you play on a wider and bigger field, and possibly, you know, have successive rounds of capital raising open to you at high multiples. Now, it's quite a few options to consider that. But if I bring it back to an example, I think you've opened, when you spoke about the capital raising stats for the year so far, you've opened up with Curro. So I'll just stick with that as an example. So Curro, the business of Curro, a private schools business, started in 1999. At that point in time, it started with one school. Over a period from 1999 to 2009, it essentially only added 2 further schools. So it ended up with 3 schools in 2009. Now, that is still growth, but it's slower growth. And because of capital being maybe a bit scarce within that space of time. But in 2009, for an example, the Peach Group invested in Curro at that point in time, invested 50 million Rand. But then the decision was taken in 2011 to list Curro on a stock exchange with the view to accelerate the growth, not only with the anchor shareholder as a supporter, but also to bring outside shareholders into the company. Now, from the listing in 2011 through to this year, there has been 6 further rounds of capital raising through the form of a rights issue, and many billions were raised. Now, just as an example how that facilitated the growth over that period of time, from 2009, where there were 3 schools, to today, there is 177 schools. So there's been tremendous growth. And that could be a factor of many things. If you want quick access to capital so that you can quickly access or capture your market share, you need to look at all options open and available to you. And the listed market is definitely one of those options that you can utilize well for the right opportunity.
Great. Yeah, Curro is just one of those fantastic case studies that have just used their listings so well. Now, Sam, if I can go to this, and perhaps, you know, this is a slight repetition of the question before, but what are the key benefits in your mind of accessing equity capital via the public markets? And of course, if you have a view on private markets as well, particularly when scaling a business.
Thanks, Patricia, and good morning to all the participants and the attendees. Really good to be here. I think that part of what we've already discussed is that access to capital. And it was interesting in the poll to see that obviously the JSE is seen as a destination for capital raise. What we have found in our discussions with investors particularly is that one of the challenges, and maybe Chris will touch on this a little bit later, is the lack of diversification for investors to invest on the stock markets. And so we think that the more creative, more innovative opportunities that are available, we need to start seeing more of those. And I love the example of Curro, because, you know, before that we hadn't seen such a high growth private education platform coming onto the market. And I think part of the success that we've seen is the uniqueness and the special offering that brings. And so really, I think that as the poll showed, access to capital is a key issue, but importantly, that visibility, the fact that somebody can open the newspaper, if people are still opening newspapers these days, you can open a newspaper and see your company, its current share price, its market cap, its movement on a daily basis. That's just the kind of exposure that, and that's a minimum exposure that you don't get in the private markets. Yeah, I think those are some of the key benefits.
Great. Well, thank you for that. So my next question, I want to hand over to first Keith and perhaps the second part over to Chris. But in terms of scaling a company for a successful IPO, and particularly in terms of management and organizational structure and corporate governance, what are the things that you look out for and look at when companies come to the market?
So first of all, and hello to everyone on the webinar, the starting trajectory is always going to be growth. But this question really, I mean, you phrased it around governance and management structures. I think a very key thing when bringing a company to market is really to make its structure and its governance transparent, clear, and simple. Obviously, in the build up to a listing, one wants to remove all conflicts of interest. You know, an example is often these businesses, small businesses, have founder CEOs. The guy that started the business is still running the business, and he perhaps rents a property into the business. These are examples of conflicts of interest that you want to really clean up ahead of a listing. You want a very clear structure in place, and then the next question thereafter is who's running the business, and what happens if something happens to them. So we're really talking about succession planning, we're talking about continuity, and we're talking about a tricky conversation around the difference between being an entrepreneur and being a listed CEO. Those are different skill sets. You know, a good example is Famous Brand, where the original entrepreneur stood back from the business, hired in a professional CEO, and he took that business to a whole next level. Now, it's not to say that all founding CEOs and entrepreneurs won't make good CEOs, but it's about being honest about what you are, and putting the right person in the right place, and then building continuity and transparency around them.
Fantastic. And Chris, I mean, is there anything else that you look at from a fund manager perspective?
Thanks, Patricia. Morning all. I think Keith touched on some of the key points that we look at from an investment perspective. But I think if you just step back, I mean, an IPO is you're basically acting in faith in supporting a management team on the initial listing, right? And you're hoping that they actually deliver on what's being projected or presented in the prospectus. I think if you look at some of our key IPO checklist items, some of the key factors are going to be around what is the actual equity story of the business. It's all about future cash flows that you're basically buying a business on, right? So what is the reason for the listing? Do we think that the earnings are going to be sustainable? Do we believe that the company can actually meet those targets that they put through in the prospectus? I mean, some advice that we can give new listings is that I think you'd rather under-promise, over-deliver than over-promise and do the opposite, because I don't think that you want to disappoint on your maiden set of results or even second set of results from there. It's all about building credibility with your investment market to be able to tap the market again for future capital raises. So building that credibility. Some of the other factors that we look at is what is the use of proceeds? Are you basically looking at funding growth, or are you looking to de-gear? Because those are two different. It has two different dynamics in terms of the outlook for the company around the valuation. I mean, so we've got the listed peers as a comparison. How does this new listing compare to the existing menu of options available to us? And then we look at how much are the founders basically holding back in the business? Do they still have skin in the game, and can they still support equity raises down the line? Because I think that also often provides an underpin for future capital raises if you've got founders that can support the business as it's entering the listed environment. And then the last couple of factors is around the balance sheet. So, I mean, what type of debt level does the business have? What's their funding needs going forward? Because that gives us a sense in terms of how much additional capital that we might need to provide to the business as it ramps up in the existing phase. And then ESG. So I put this last, but I mean, I think from our perspective, this is the number one factor that we are looking at in terms of, as Keith touched on. I mean, are there any related party dealings that we need to be concerned about? Is there a key man risk? Is there proper succession planning? How deep is the management bench within the company? I think when it comes to related party dealings as well, I think we always mention this point about it's always challenging when equity shareholders are subordinated on the return profile to other JV partners, because that doesn't end well for us as an equity holder. So those are key red flags that we look at when it comes to the IPO.
And I think those are all very valuable points, and I think it's great that the audience actually gets to hear both from an advisor and also from an investor perspective, because a listing is not really just about ticking the boxes, it's making sure that you've bedded down why you are listing, what are the key strategic objectives, and essentially what is the equity story, and also corporate governance playing a major role in that. So I thought that maybe we can just do our second poll. We did ask you in the first poll why you would list, and for the second poll, if Sihle can then just bring that up, the question is, what would prevent you from listing on the JSE? Is it, first of all, the additional regulation and public disclosure, costs? Is it the diluted control, or perhaps none of the above? And those results are coming out, and it looks like it's a 50% to costs, which is also very interesting, and we can, I suppose, break down the cost discussion a little bit further. All right, fantastic. So it looks like many of you feel that costs would be the biggest hindrance, perhaps, of you tapping the local equity market. In our research, we have really shown that it's not really the JSE costs which are the larger and significant costs related to any listings, but it's the much needed third-party advisory costs. It's those costs that you need to pay for advisors, for the initial capital raising, for the auditors, and all those related costs. But that's also, again, very, very interesting. So to go into our second panel discussion, what are the key considerations for a successful listings, or for a successful listing? And let me ask Sam the first question. What are the avenues available for raising capital in the public markets?
Thanks, Patricia. Before I go into that question, I think that the poll was quite interesting. The second poll. I'm surprised that the dilution issue is not a concern for attendees. I did notice that we've got 20% parties who said that none of the above, and so remember that we do have a Q&A section. So if you want to maybe unpack what you meant by none of the above, we'd love to hear from you. So please put those in the Q&A session, and we'd love to hear what the thoughts are. I think that, you know, in terms of avenues for accessing capital, really what's worth repeating, Patricia, is your separation between Altex and main board, and really I think that there are two different types of mindsets. When you are an Altex company, what you're saying is that I am still an SME and I am geared for growth, and I'm looking for partners to fund that growth with me. And I think that your type of investors will also align with that. So you're looking for high net worth individuals, you're looking for retail investors, and so I think that your capital raising effort is in line with that. And what we often think about as the JSE is make sure that your advisors are fit for purpose. So advisors who have worked on more SME type capital raisings will know that that path and that particular segment better than if you are coming to us for a main board listing and you're an established business doing good turnover, good kind of capital base, the 3-year worth of trading history. That may be a different type of advisor, and also because you're going for a different type of investor as well. So you may be looking for more institutional type investors who will ask a different type of questions. The questions may be less around growth. Will always be important, but like Keith has mentioned, like Chris has also mentioned, you start to get very interested as an institutional investor around what your governance is, your conflicts of interest, like we've spoken about. I love what Chris mentioned about management depth. Do you have a backbench of strong second and third tier leaders if you are going for the institutional money, if you are going for the larger listing?
Great. So let me ask Willie and Keith, both from an advisor and an investor perspective, if you've got any additional points in terms of what really makes a listing successful, particularly in the small to mid-cap issuance. And I think Sam touched on it from an advisory perspective in terms of appointing the right advisors, but what other points can you add to that?
So Patricia, maybe I just want to go back to Sam's point on dilution. I think another view on that, the fact that the audience said that they don't get bothered by dilution, it's maybe a good view to have a smaller slice of a bigger pie than a big slice of a small pie. And that's what the listing naturally could potentially bring for you. But to come back to your question, Patricia, I think how we as advisors look at what would make a listing, and in this case a smaller kind of company, a mid-cap company, a potential successful listing, is we take a lot of the views on board, such as what Chris has alluded to earlier and what Keith has alluded to. And we start off by saying, firstly, let's look at the underlying investment opportunity. What does this mean for the market? Because if the market is not going to support your listing through providing capital, you might as well stop right there. Because ultimately the audience indicated that they come to market to raise capital for growth. Now, we will look at that company, we'll see, what sort of life cycle is it? Is it a growth company? Is it an investment that the market will clearly understand? Does the management team have a clear strategy? So we'll go through a couple of boxes and tick that. If we're happy that can now move to the next phase, we will go and put that management team in a market sounding scenario in front of a select group of institutional and private client platforms, and let them present themselves, the business case, and so on. And we will sort of get an initial feel of the view from the market and do initial pricing to the market. We will go back, we'll regroup, and to the extent that we have to refine anything with the feedback, we will do that, we'll incorporate it, but very specifically, we want to make sure that the pricing that we've put forward, initial pricing, is actually in the ballpark where the market will support us. If we get all those confirmations, what we'll then do is we will start marketing the overall listing aggressively, far and wide through various mechanisms, because ultimately what you want to get to a scenario is you want to have a good, very much growth story that you bring to the market at the right price, where there's still some money left on the table for the secondary market trading, where it's been marketed very well, the book has reached an oversubscription scenario, potentially parties have to be cut back, and people who really want to get the stock will have to buy it in the secondary market. So you've got a share that trades well in the secondary market. So that's a good story to tell to the market. But also, I think it was mentioned earlier by Chris, what the market typically likes is, as I said, a growth story at a good price, where there's not too much insider selling, where capital is raised for growth rather than settling of debt. Now there's a landing ground between all of those things, but you'll get more support, and which will point to a much more successful listing if there's less inside selling, less for debt settling, and more for organic and acquisitive growth. So yeah.
So Vinny's touched very nicely on a kind of road to a listing. A lot of the things in the background, the consideration that builds up to that. I mean, what I'm going to add to is less of what happens in the background and more as an investor sitting in front of that management team, working through the listing and deciding whether to put capital in or not. And Chris touched quite nicely on a series of kind of tick boxes, from ESG to the governance and transparency, absence of conflicts of interest, and all that sort of nice stuff. Those are tick boxes. Obviously, if there's red flags in there's a problem. Assuming you're comfortable with that, it doesn't necessarily mean that this is an attractive listing. The final consideration is what the underlying business. Now, if you're coming to the market for the right reasons, you're coming to it with a growth appetite, raising capital for the right reasons to deploy it into a return-generating process, business, asset, or direction. So the question has to be asked is, what is your business? And what is your strategy to grow? So the word sustainability is thrown around a lot. I think it's quite overused, but unfortunately, it does summarize quite nicely the type of growth that we're looking for. We're not looking for a once-off growth. One has to make sure that this strategy makes sense. However, the business is going to grow, makes sense. It is repeatable. There is a large addressable market. And one can execute on it, and as far as possible, have demonstrated in the past that it's executable and repeatable. Then the consideration comes around, assuming we're comfortable with all the softer boxes that we've ticked, we're comfortable with what the business does and how it intends to use the capital to grow. The question comes in, how is it priced? And that's obviously a very investor-specific question. There's different ways to approach it, but I would say one doesn't want to give your business away for free, but in order to get that initial positive momentum in the stock market, I would not come towards the high end of the fair value range. I would come towards the middle to the lower end. So you leave a little bit on the table, and that effectively is buying you a bit of goodwill in the market. It's ensuring there's appetite for your script, and it hopefully provides a positive momentum such that if you need to go back to the market to raise a second, perhaps third round, for example, as Billy touched on, Cura has done, you have that goodwill, that faith in the market already, and that positive momentum backing you.
Great. So let me also then ask you, just very briefly, Chris, and I'm going to ask you this particular question is, why do you think some IPOs fail? And I think we touched on valuations, and perhaps that's an element of it. But from your perspective, what are the key kind of top 3 reasons why IPOs fail?
Great. Thanks, Patricia. I think Keith put it very nicely in terms of leaving something on the table. So my first point is going to be around valuation, where it's probably hasn't given investors enough of a margin of safety around, should things not go as planned, there isn't that much of juice basically left in the story to basically weather a downturn. So valuation would be high up in the list. Other points would be around the quality and track record of management. If there's questionable analysis around how much of the growth has been organic growth versus poor acquisitions, because that then talks about a poor capital allocation, that we're basically trusting management with our capital to execute on. And then things around related party, which we've touched in the past, and a tough competitive environment. So if we think that it's going to be tough for the company to basically maintain a type of moat that they've got that's supported their earnings in the past, can they still continue going forward? Last factor is around a tough market. So if the market is very volatile and there's a bit of a risk-off sentiment, that's going to impact your peer valuations, which then is going to impact the listing environment that you're going to have to come and offer your shares at, which will make it hard. I think if we summarize poor IPOs or IPOs that failed in the past, I think WeWork's a good example, where it basically was a very capital-intensive business. There were question marks around the sustainability of the growth. There was high gearing because of the leases that came through, and then there was a whole host of other ESG challenges as well that were red flags to us.
Great. And I think the last question for this particular theme is, Chris, I want to ask you this one as well, is how do you time the market? You spoke about volatile, tough markets. How do you time the market in coming to a listing in a market like this? What is your view there?
Yeah, look, I think on the market timing question, it's always difficult. It's almost similar to trying to time buying a share in the market. I mean, you're never going to be able to pick the bottom of a cycle. For us, the most important thing is, firstly, our market's conducive at an overall level. So I think if you look at March this year, there was so much volatility given what was happening with COVID that would have been a very bad time to list. But outside of that, I think companies do need to look at what they can control, and that's within their power. So I think you've got to stick to having an offering that investors actually want to participate in. So you've got to develop a strong business model that has your own sustainable earnings profile. You've got to have a strong team behind you. We talk about this management bench. So you've got to have depth in terms of the management team that's going to be running the business. I think it's also important to have a strong advisor that has good relationships with the equity investors, because that feedback that you get in the various stages of looking to list is very important. And whether investors have got question marks on the valuation, or they've got question marks on some of the other related party dealings, for example, that feedback is very good, and being able to have flexibility around changing certain things that then allows investors to basically invest in the company at IPOs is very important. And then allowing enough time to actually list the company. You don't want to have something like a tight schedule, which basically means that you're trying to force investors in a quick timeline to make a decision to invest or not.
Patricia, if I can jump in a little bit there, and I agree absolutely with what Chris said, but look at the variables that you can control as a business listing, and try to control those. Assuming that you have a superb business, great track record, clean structure, great governance, fantastic. You tick every box, and you have a fantastic plan in order to grow. I would say that don't time the market. Listing at any time, there will always be an appetite for a superb priced growth story. I mean, people like myself and Chris are incentivized to find these no matter what's happening in the market. So there's always capital available if your story, your execution potential, and your pricing is correct.
Very good points and very interesting there. So for our third theme is what key learnings from previous listings. And really, with your significant experience in working in the listed market from an advisory perspective, in your view, how does management prepare for an IPO and a listing on the public markets?
Yeah, thanks, Patricia. I think this is quite a big mind shift, going from a private company to a listed market. There's more stakeholders that you've got to report to. You need to adhere to more regulation as well, and your results are public. So that opens you up to scrutiny, not only by additional shareholders, but also the media, and your competitors can also see what's going on inside your business. Now, naturally, I don't want to just raise negative points, because I think the benefits outweigh tremendously. If you use the capital markets for the right reasons and you use it well, you can grow your business very well and get the additional benefit of visibility to a wider audience as you do that. But we would typically, sit down with the management team once they have, the board has made the in principle decision to explore a listing. We'll go through all these additional requirements with them, so that they can fully understand what is the road that lies ahead for them. So naturally, there's a couple of things. There's the actual listing process and what that entails, but then there's also, once you are listed, what does that then mean? So we will look at any additional strengths that need to be brought on board in the management team, but maybe also on the board, to the extent that there is training required, that they can actually perform at that listed level. We will advise them to do that. And walk a road with them, so that by the time that we take them on that initial market signing roadshow that I alluded to earlier, they're ready for it. They stand up to the investment community with confidence, and they're ready to sell their story to the market. Now, there's a lot of hand holding to be done, and that's one of the functions that advisors have to do. both in the listing process, the preparation for it, but also afterwards. That's why there's a sponsor or designated advisor to each listed company to make sure that the companies operate within the rules and the requirements. So yes, there is a lot of work that has to go into it, with the management teams to get them ready for the market. Because ultimately, when you sit in front of Keith or sit in front of Chris at Marzi, you almost need to give your best performance on a first engagement, so that you instill the confidence, you sell your story well, you come across like you know where you're going, and that will give the market a greater comfort as you tell your story to give you capital to be partnering with you. So yeah, but it's a process, and we walk with the companies as they prepare for that.
So in terms of case studies, we spoke about Curo. We've got Andries, who's going to be telling us about his success and kind of what his rationale was for accessing and tapping the local equity market. And Billy, you spoke about, the balance, or kind of when you sit in front of the investors, you obviously need to have your story in place and your strategic objectives. But from previous listings, is there an ideal balance between retail and institutional, bearing in mind that South African market is largely institutional, and of course there is an element of retail, but maybe if I can get Chris and Keith to kind of come in on from their perspective, in terms of what is the ideal balance based on previous listings, the balance between retail and institutional investor splits.
Okay, thanks, Patricia. I think there's a couple of myths when it comes to involving retail investors into an IPO. I mean, the common comments that we hear here, I think, is around retail investors are not long-term focused. They will potentially look at flipping post-listing, or the process of actually involving retail investors is too cumbersome from a regulatory perspective. If we look at past listings, I think those both have been debunked. There's numerous examples of involving retail investors in a listing that hasn't actually had those challenges. From an institutional investor perspective, I think it also helps the process as well by having a diversified blend of shareholders. So that means involving retail investors into the shareholder base. From an SA perspective as well, I do think that we need to stimulate retail or private savings. It's something that we actually are lagging the rest of the world by, especially when you compare ourselves to like Australia, Japan, and the likes, where they've got much more developed retail markets. And just some anecdotal evidence as well, what we're seeing out there as well, is that there's been recently a deal done by the LSE to actually partner up with a company called Primary Bid, where they're basically looking at aggregating retail investors. So you have a pool of retail investors that then participates in an IPO, because often the challenge with retail investors is that they're price takers in an IPO. They don't have a pool large enough to basically have a bigger say in terms of price discovery when it comes to the actual listing. So these are some of the initiatives that are coming around globally to try and support the retail investor and let them have a bigger say when it comes to the IPO.
So to add what Chris said, is as a rule of thumb, when deciding and you've done your roadshow, you've got your applications in, and you're deciding how to allocate your book or even to focus your roadshow, I would say err on the side of too many retail investors. The reason I say this is pretty simple. What the retail investor brings is he brings liquidity. Even though some might sell post-listing, that's not a bad thing, because for every seller there has to be a buyer, and if your stock doesn't trade, it doesn't have a share price, it's not very liquid, and in fact then you start to get penalized for that. So err on the side, as a rule of thumb, err on the side of too many retail investors as opposed to little, because also in the background, institutional investors like myself and Chris, and there's a whole world of institutional investors out there, we are incentivized to find those stocks. So if we like it and we didn't get any in the IPO, well, we're always going to walk into the market and buy it anyway. So that's not a problem. Which I know it sounds like I'm shooting myself and Chris and other institutional investors in the foot, but I do think the retail investor is an underrepresented part of the IPO process, and it brings a lot of value in bringing that. That said, having a reference or an anchor institutional shareholder or two definitely adds a lot of confidence, and it's a very good sounding board in order to seek those out. But don't anticipate them, for example, adding to your liquidity or free float in the market, because most of them have done their due diligence, they like the investment, and they're going to sit on it for 10 years in the perfect ideal world. So, and I go back to my point, when in doubt, err on the side of too many retail investors.
Patricia, maybe if I can just balance the books between Chris and Keith from an advisor perspective. I think both sides are critically important for us as advisors looking to fill a book and get a book oversubscribed. There's a good balance in South Africa between institutional and private client platforms, and frankly, I think all of us will be quite surprised how many retail platforms there are in South Africa that want to provide capital to listings, but sometimes just get completely ignored in a listing process, and where the advisors typically just stick to the large institutions. Now, if you have a large capital raise that comes with a listing, I think you cannot ignore the institutions. The institutions are there to fill the bulk of the book. The retail then brings the balance, but I think as Keith has rightly indicated, the price discovery that almost happens in the secondary market is very much driven by the retail guys. And as a lot of people are also cut back in a listing book, in a post market, it's usually, I'm not saying it's always the case, but usually it's the retail guys that get cut the most, and the institutions are given a bigger portion of their allocations because they're bringing the large bulk of the money. But it's those retail guys that go into the secondary market and buy whatever they wanted to have in the first place, and that leaves a happy situation for a successful listing. So definitely, as Keith said, I think the retail guys must always be given the opportunity to also look at it.
Great. So just in the interest of time, I really want to get to this topic is in terms of what are investors looking for in newly listed companies and IPOs? And I suppose post-COVID, where are Chris and Keith, where are you looking for opportunities and where are you looking for yield? Are there particular sectors, particular industries? What are you looking for?
So first of all, and you used the word looking for yield, Patricia, I tend to be total return, so I'm yield and growth agnostic. The point is to generate an investment return. Where one gets that is opportunistic. But in the post-COVID world, I do think it's proven the value of the healthcare sector, which I think over the last decade or so has become riddled with compliance and regulation. So it started getting an overly low valuation, whereas this has actually proven how necessary and what a vital sector this is in the world, particularly if one is cleverly positioned in that sector. There are definitely opportunities, and we've been sitting in a world where big tech has rallied, but healthcare has lagged. Now, big tech, absolutely. We're busy talking on a digital platform at this point with attendees and the like, and big tech absolutely has value in a work from home and a remote working world, and it's proven that. But I don't think it's justifiable that healthcare should have lagged so much, particularly if one looks at who's actually solving the problem. Then also in a lower for longer interest rate world with potentially sovereigns going increasingly negative, I think gold and commodities, so physical assets, start to become attractive, with the caveats that I'm less bullish on property. I think in the financial sector, a kind of geared beta play that is undervalued are the asset managers. There's some very good quality ones around the world. And then there's obviously some very unique themes. Guys being trapped in their houses for 6 months has led to a boom in DIY sales. So building materials is quite a unique one. We've got self-storage. I think the private residential, property market might be quite a unique story as well. And then obviously the strong online and non-discretionary retailers if one can get them at good and attractive prices, start to become very interesting value propositions. Chris, have I left anything for you?
Very comprehensive, Keith. I think the only other ones that I can potentially think of is things around so home fitness is something that we've seen play out quite nicely in the US. So guys like Peloton, which has got your treadmills and your basically spinning bikes, that's taken off very nicely. I think the challenge always is going to be if you get competition coming through from something like Amazon, given their distribution network, that could be a problem. But that's done well. And then things around like PPE, so hand sanitizers and the likes. There's been quite a bit of demand in a post-COVID world. And the last thing was around just on the e-commerce trend that we've seen. So while property as a whole has taken a lot of pain given the work from home situation, so that's impacted retailers and the office segment, but your quality industrial plays have actually performed very well. There's lots of demand for well-located industrial warehousing that plays into the logistics segment or even an e-commerce takeaway opportunity as well.
Okay, well, thank you very much. And I suppose the good thing is that now the audience out there knows what investors are looking for. And of course, this is only a sample of two. We've, I suppose, got a lot more, but I think those are pretty much in line with global trends and investor views in terms of looking for yield. So that is certainly very interesting. Now, really, in the interest of time, I want to give the audience an opportunity to ask some questions. We do have Andrews, who's the Chief Executive Officer of Afrimat also. I'd really want to bring you on. If you can just tell us a little bit a brief view of why you listed, rationale, and some of the successes, please.
Good morning, everyone. Good morning, Patricia. Yeah, we listed it quite a couple of years ago. We listed in 2006, and at the time we merged two little companies. The one was a company that I co-owned, and the other was a company that I used to work for previously. And there were two main reasons. The one at the time was to raise capital for the business that my partners and I just bought, and we still owed a lot of money. And secondly, the company that we merged with had owners in there that were at retirement age and was looking to unlock the value. So the benefit of it at the time for us is, well, firstly, we could raise the capital that we needed and still retain a significant share in our business. And secondly, the tradability of the business helped the guys with their retirement, although they're still shareholders. They haven't actually traded, but they're still here. And at least if they wanted to trade, they can. It also gave us currency because our original plan was to consolidate an industry, and it gave us a currency to consolidate an industry and get the owners of small businesses at the time, give them the feeling that they were becoming part of a bigger whole, and gave them that feeling of ownership. And the last thing that we got, and we didn't actually go out to look for it, but that was one of the positives that we got at the time. It did change the stature of the business from a small private-owned business that nobody knew of to a publicly listed company where people start presenting opportunities to us, and that has really helped us grow. And we've had a very nice growth rate since the 2006 listing, and the company's grown quite nicely since then. So looking at the company and why we listed, I think there were other benefits. Looking from my colleagues that have retired, one of the benefits that they get that sometimes is a bit of a frustration for us is there's quite a strong governance oversight from the JSE and things like that. So for exiting shareholders who are not actually working in the business anymore, it does give them that comfort that the new management is being checked by somebody and the governance is in place. I think Willie made the point a little earlier about the public scrutiny. That's also actually a positive, because the whole management team is under scrutiny from investors and from the press and from everybody else. So it makes sure that you do toe the line and things like that. And the last benefit that we got that we didn't really think of in the beginning is the whole sense of co-ownership. You know, as we brought strong managers on board, we could incentivize them with share options and things like that. And I know a lot of activists don't, you know, really looks at that with a very fine comb. But the positive of that is people are actually feeling co-ownership, and I saw that just a couple of minutes ago in a meeting where I was, where one of our very senior guys, we were talking about the development of our younger people. It was a personnel development meeting, and the guy said, yeah, remember, I'm a shareholder here, and when I retire, I want somebody to still pay the dividends, so we must make sure that we get these guys developed. So those are the benefits that we got. Let me leave it at that for now.
Very interesting. And you know, Andries, in terms of Afrimat, I mean, it's certainly known to be quite a good dividend play. You've obviously been yielding quite good returns and also paying the dividends to the shareholders. You know, I think from an employee perspective, it's good that you've got that empowerment, empowering your employees to be shareholders, and I suppose it just makes them more committed to the business. Let me ask you one last question. How has your business changed? If you think back to pre-listing to where you are now, I'm sure you are bigger, you've got a easier way to raise capital, and perhaps people know more about you, but how has the business changed?
Well, I think the business has matured a lot. You know, when we listed in 2006, it was 2 privately owned little quarrying businesses, and you know, run almost by the seat of the pants in a certain way. And we've matured a lot. We've developed a very strong next layer of leadership that has come through and has grown the business. New opportunities that came our way. We've done a number of acquisitions over the years, and fortunately, most of them have worked well. And so I would say, you know, the business has changed in terms of size. The size has changed. In terms of proper procedures and systems without becoming too bureaucratic. That's a big thing for us, not to become a bureaucratic organization like a lot of the big corporates tend to become. But that's actually just when you've got lazy, useless people, then they create all sorts of systems not to do the job. But if you have very good people, then you sort of just get some basic systems, a basic structure in place, so that the business can work, and that, you know, we operate 41 little mines around the country, so you've got to have that sort of systems and processes in place. So size, structure, and procedure has improved, and I think the whole thing around the importance of having a good culture in the business that can be scrutinized by anybody, that was actually a very positive thing that has developed over the years. I think the company culture has grown a lot. Yeah, and then the opportunities that we've been offered and still are being offered. You know, we at any given time we have more opportunities on the table than we can execute on, in terms of people that we have available that can execute that. So yeah, those are the main things that have changed. But mostly, the most important thing that have changed is the whole thing about public scrutiny. You know, nobody, in the days where people would take a chance at a quarry to do something that is actually not legal, the guys are very nervous about that now, because they know we're under scrutiny all the time. And that's a big positive. You know, it makes my life easier, because I know that the quarry manager out there in the sticks is not going to do something that's highly illegal, because he knows he's going to be in the newspaper the next day, and then he's going to have trouble.
Well, there you go. You've heard it from a CEO, and instead of just hearing from JSE executives, investors, and advisors, you can also, we want to give you an opportunity to ask some Q&As. Sam, do we have any questions that have come in?
Yeah, we do. Thanks, Patricia. Maybe before jumping into the 3 questions that have come through, to all the attendees, please note we still have some time, so bring those questions in. Andres, good to hear that you have a positive view of JSE oversight, and specifically how that. But particularly how that trickles down into the organization. I think that's a useful insight. We spoke a lot about how the advisors can help you through the IPO process and around setting the right price, around timing, not to time the market, to try and time the market, who to go to, and you know, my reflection from my days as an advisor is I think it's also important for the company to listen to the advisor. Sometimes it's easy for owners of businesses to be emotionally attached to valuations, business plans, and sometimes it's important to make sure that that the advisors are listened to, as they have a good sense of where the investor mindset is and how to do that. I think another point that we are helping issuers think through is that, you know, once you list, you don't just list and then carry on life as normal. I think it's important to be constantly speaking to investors, proper road shows. We've been doing webinars recently with parties like the Investment Analyst Society, and we encourage investors, issuers to keep engaging with the ecosystem and with the market once they're listed, specifically in the small to medium size sector, where maybe coverage is not as strong either in the media or in the research space. One really has to go out and make sure that that they are speaking to the market. So just to jump into some of the questions, Tinas raised an interesting one to say, well, what would be considered as a minimum target market cap to consider listing? Maybe Vili, you can take that one, and Keith and Chris, if you want to jump in after Vili. I'll read all the questions just to give some time to think. Bafana wants to know whether this recording will be made available and shared. Bafana, we will put the recording onto WeTransfer, and attendees will get an email with that link. Menakem asks, you know, can we do with less than the 15 million annual profit before listing? I think the point there is there a minimum profit level, and certainly on the main board there is, but if you're going for an Altex listing, then you don't need a pre-tax profit history. All you need is a minimum of 2 million rand share capital, and really the Altex is there to say we want to partner with the national agenda around SMEs, which are obviously job creators, and so it's important to make it easy for companies to approach the Altex that way. Maybe let me pause there and ask Vili to take, and the questions are now coming in fast and furious, so attendees, thank you for your questions. But maybe Vili, if you want to take the kind of minimum listing market cap target question.
Sure. Thanks, Sam. So I think maybe let's talk around how one should think about it. So naturally, the larger your, and let's for a moment also assume that the company that's coming to market is something that the market will like. It's a growth story. It's reasonably well priced. It's less debt settling, more for M&A, and less inside selling. Sort of sketch the basis. Now the question is, what is the right market cap size company? I think how one should evaluate it is, the larger the market cap, the more potential parties that would be willing to look at the opportunity. Now, if your market cap goes smaller, your audience gets smaller. Now, the answer lies somewhere there in the middle, because some institutional investors, or let's also just frame around, ultimately, once a stock starts trading, liquidity plays a huge factor for market participants, specifically for institutions. You know, because if something goes wrong and you can't exit the share, then you just get marked down day after day, as small retail investors maybe put the share down. So I think a good successful listing comes with you know, liquidity in a secondary market. Now, a number of large institutions, if a share is say less than R1 billion market cap, then they don't even take a meeting, because they know that the liquidity will not be sufficient in a secondary market. However, there are other investors that have less liquidity constraints, and they would be maybe open to negotiation on the price to provide you the capital, and they would take that liquidity risk with you as you grow, because you've sold your story. You've told them that you are going to be you're a small cap now, but you've got ambitions and growth, and they back you for that. And we've seen many examples like that. I think Andries' company, Afrimat, is a great example, and there are many of those where they are starting out small, but there's a team that you trust. There's a dream, there's a strategy, there's, you know, and there's deliverables that will come through, and you trust that team, and you make great returns along that path. So I think guys who've got companies shouldn't consider not listing because they think the market cap shouldn't be sufficient. There are pockets of capital all over South Africa and, you know, beyond our borders that will back the right team with the right idea and plan. And as you grow, and we've seen this even within our PSG group stable of companies, as you grow, eventually the large institutions come and knock on a door and say, at the next capital raise, I would like to be part of it. And so your spread and your shareholder makeup changes over time. So I'm not going to say the answer is you have to be more than 100 million or more than $1 billion. The answer actually lies in what is your offering to the market, how much capital do you need to raise to get going with your plan, and then you go from there.
If I can add to what Billy said, and I absolutely agree with everything he said there. I think that's a very good summary. But perhaps a way to approach it is one shouldn't target a size. You should target appropriateness and relevance, and the size will sort itself out. Particularly if you're a growth story and you grow into it, you will hit those milestones along the way. So think about how much capital you need and what your target is before you think about your size. You know, even a small company, but with a good enough growth story, there's an entire world out there incentivized to find you. Just focus on executing. Then the second thing that I will add that sounds contradictory to what I said, but this is classic stock market, where there are opposing vectors. So what's not well known is in the Collective Investment Schemes Act of South Africa, which is relevant for unit trusts and hedge funds and all sorts of formalized, well, collective investment schemes. They have a clause that is hard written into the code. So it's not part of fund managers' mandates. There's no way around it. But if a company has a market cap less than 2 billion, fund managers are not allowed to hold more than 5% of their portfolio in it, except in certain circumstances, et cetera, et cetera. So on the one hand, target relevance and appropriateness, don't target a size. But like I said, and I go back to earlier points we made much earlier in this panel discussion, the stock market is a growth-hungry machine. So come to market with a executable and repeatable growth strategy. And what you'll find is as you grow and you start to hit those marks, you transition to a R1 billion company, then a R2 billion company. It's not a linear progression, it's an exponential progression in terms of the appetite in the universe that opens up for your script.
Thanks, Keith. Letu really wants to know about the debt market. So Vili and Letu's also asked me to comment on this. I'll jump in after you if I need to. But Letu's question is, in terms of debt instruments, briefly take us through the process from approval of a listing to the roadshow to investors. How does that work? Letu also has a question for Chris and Keith on the debt market to say, well, how do you benchmark the valuation on a corporate bond, or how do you benchmark the pricing relative to prevailing interest rates, inflation, etc.? And Chris, and Keith, if I could maybe augment Letu's question to say that, you know, we've seen, you know, when I was in the debt market early part of this century, you know, there was some excitement around corporate bonds. That seems to have died down a bit. So maybe in answering your question, Chris, maybe just give us some thoughts on where we are as a corporate bond market. If there is still life left there, how do we revive it? And what are your thoughts on there? But maybe Vili, do you want to take us through the process of a debt listing?
Okay, thanks. Thanks, Sam. So look, as with an equity listing, there's a formal regulatory process that has to be completed. With an equity listing, if you market to the overall market, then you use a prospectus. If you only market to certain qualified investors, there's a pre-listing statement that you issue. In a debt market, there is a program memorandum that you have to establish, and it's got all sorts of rules and terms and conditions that the market will use to subscribe for your bonds. And then following that, there is what we call the applicable pricing supplement, where you issue a specific bond with specific terms, but it's under the body of your program memorandum, which is essentially the Bible of your bond program. Now, in terms of you know, marketing it and so on, it's slightly different to an equity element, because the debt market provides you capital, which they ultimately want back at you know, at a certain point in time. Now, they look at you as an issuer of debt in terms of the ability to service the interest component or the coupon, and your ability to repay the capital when it comes up for maturity. Whereas in equity market, they actually look at how you're going to grow your earnings and distribute dividends over time. So they look at it from a slightly different angle. But when investors evaluate you as a company coming to market, they're going to look at your business as an equity investor would look at your business. They're going to look at your current gearing levels to see how much pressure there's already on your serviceability. You could also consider you know, issuing a bond on a secured basis. Maybe if you're a property intensive company, you know, you can put some properties as security that should you not be able to service your coupon, then the debt holders can claim security in that regard. But what typically happens is, say company X comes to market, it would, in order to give investors a bit of comfort around its creditworthiness, it would obtain a rating from a reputable ratings agency who would typically evaluate the business in great detail and then issue a note to the market to say, we've evaluated company X, it's got a stable outlook, gearing is not too onerous, and it is a certain rating, either investment grade or sub-investment grade. Now, most institutions do their own work over and above that. That is just used as a guideline for them. But ultimately, how that reflects in terms of the capital that they provide is in what we call the margin. So you would come to market, say, I want to raise a floating rate bond, which is typically to JIBAR, which is an interest rate. And then there's a margin on top of JIBAR, which reflects the risk inherent in that specific issuer issuing debt. So the higher the margin, it means the more risk there is in it, and the lower the margin, it means there's less perceived risk. So you pay less interest in total if you are able to service and repay the capital much more easier, and you pay a higher interest rate if there is perceived lower serviceability.
Thanks, Vili. So Chris, I don't know if you want to add any more onto the pricing part, but specifically, I'm also keen to hear your thoughts on how this market, what the future holds for this particular part of the market.
Yeah. Okay. Thanks, Dan. Look, when it comes to pricing, I think as Vili touched on, it's basically around what is the cost, what is the cost of credit or the margin that we've got to apply over the government or JIBAR rate. How we look at it is similar to like an equity issuance. We look at a peer analysis if there are peers out there. So what is your debt metrics? What is your gearing levels? what is your, say for example, net debt to EBITDA numbers that the company has. That then allows us to try and look at a peer analysis to say, if you look at the market right now, where are your peers pricing, which then gives us an indication of where your notes should price in the market. If I can give some advice to new issuers, it probably makes sense to build a track record by issuing shorter dated notes and then showing the ability to either refinance these facilities or settle the facilities before you start looking at longer dated paper. The advantage of that is that if you can issue paper under 13 months, that allows you to then attract money market investments as well, where we're seeing quite a bit of appetite now, opposed to just straight corporate bonds, which can actually invest in longer dated instruments. So build the track record on shorter dated paper. From a mandate perspective as well, there's also some regulatory restrictions that we've got on our funds. So whether you're going into listed versus unlisted notes, that then has a limitation in terms of how much we can hold in the portfolio. And similarly, if it's going into rated versus unrated paper, because some of our mandates does have a limitation in terms of investing in whether it's investment grade or non-investment grade paper, so that then limits the appetite to include it in the portfolios. From a corporate bond perspective, I think once you go out of the bank or even the AAA rated paper, that is something that needs to be developed in our market. So I know the JSE is looking at initiatives to try and improve the secondary market trade of corporate bonds, because I think if you compare SA versus global peers, our corporate bond market needs to be developed further. Often what we find is that it's almost like a who you know type of event to try and source corporate bonds once you go out of the investment grade market. So that also then helps us from a pricing perspective to show that, look, the price is not stale and there is liquidity to try and get some of the credits. We are also seeing some new initiatives come to the market as well, where guys are launching platforms that allow us to go directly to certain unlisted companies or listed companies that don't have formal debt programs. So that's almost like a reverse inquiry, where we can go and speak to a corporate where we feel that we understand the business outlook, and we can go directly to the treasurer and say, look, we've got appetite for 6 months paper. Here's a off-the-shelf solution to issue paper via this platform. So the guys are looking at opportunities to try and improve liquidity in that segment. But there is work that's required there.
No, good. Thanks, Chris. So Patricia, we have exhausted our questions. You did have a third poll, I think, if I remember correctly, and maybe we can run that. We've got 10 more minutes in the webinar to go, so maybe we can run another poll and then have some closing remarks.
Great. If Sihle can just bring that up. The last poll was whether listing is a strategic objective, a 5-year strategic objective for you, and that's a simple yes or a no. And as we wait for that to come in, majority of it is yes. So it looks like so far as they're coming in, we've obviously done a very good job to sell our audience on listings, and many of them, perhaps if they have not considered listing, now it's definitely a 5-year strategic objective.
No, that's fantastic, and yeah, we're looking forward to really welcoming new issuers onto the exchange over the next few years. So maybe just some closing remarks from my side, and then we can let other panelists also put through some closing remarks, and we'll call it a day. But I think that, you know, I mentioned the national agenda and really the numbers that came out this week around unemployment, around the job losses due to COVID, and in fact the pandemic's impact on our economy and our markets has really required us as a country to search for some answers, and I think that one of the answers is to really put more effort into our SME segment, and in terms of the JSE, we want to become a platform more and more that brings capital and opportunities together. And I think what the panelists have indicated is that capital is looking for those growth stories, and even if you are an SME, from a requirements perspective, the Altex is available. Even from a main board perspective, I think those requirements still fall within an SME kind of definition. So we're hoping to welcome more smaller caps SMEs with some of the advice from the panelists in terms of how to make a listing valuable on that platform. Of course, large caps are the stable of the JSE, and we're looking forward to more large caps listing on our market as well. I think the questions around the debt market from Letu was something that we didn't expect, and that was a good surprise. And certainly that is a market that is underutilized. The platform is available. Again, what investors are telling us is that they need diversification, they need more issuers, they want to look at, across the market. And so where there is appetite for debt listings, the JSE is definitely a platform to bring those listings on board. So hoping that some of the yeses on the listing objectives over the next 5 years include some corporate bonds. Thanks. Maybe Andries, we could get your closing comments, and I'm just going in the order that I'm seeing everybody. After Andries, Chris, Vili, Heath, and then we can close with you, Patricia.
Yeah, thanks, Sam. Maybe just in closing, I don't think Afrimat would have been able to grow the way we have grown if we were not listed. We've had a lot of benefits. It has its challenges. The whole thing around the JSE and all the rules and things like that does put a bit of complexity in the business. That is a bit of a downside. But all in all, the growth would not have been possible, and what has been a very, for me personally, a very exciting journey for the last 14 years would not have been possible if we were not listed.
Thanks, Andries. From my perspective, I think I just want to echo what Keith has said earlier in terms of investors looking for good businesses and opportunities for us to actually create good returns. And if I just maybe finish off with an example of Renogen as well, when they listed in 2015. I don't think there's a minimum size or minimum size that you can look at on the listing. As long as you've got a good story where investors can actually understand your growth profile, they back the management, and it's a management team that we can trust, I think you're always going to have appetite for investors to support your business. And I think just one last thing on Andries and Afrimat. I think one of the key lessons that investors can take from the Afrimat story is that the organic growth or the accretive acquisitions that the business has done, they haven't continuously come to market to raise equity. They've bought businesses using debt and also on existing cash flows to grow the business. So it hasn't been a lazy acquisitive growth story. And I think that also shows us the track record of the management team in actually doing good accretive deals, which then builds our faith in the team. Congrats again.
Well, thanks, Chris. I think from my side, if you are sitting and listening to us now and thinking, I'd like to list, but in my mind, I'm not of the right size, or, maybe the market will not give me a warm reception or anything. I think don't let that be a stumbling block for you. find yourself a really good advisor that knows the investment community very well and that understands businesses very well, and sit down with them and speak to them, tell them about your business. And yes, maybe you are not ready. Maybe there may be a reason why you're not ready, but that advisor can say to you, maybe we should put you and another business together. Then it's a different proposition to the market. So at least engage and start that initial process. And any good advisor who knows the investment community well may say to you, look, there's a lot of investors through mandate restrictions, as Keith has alluded to, that may not be able to invest, but we know investor 3, 4, 5, and 6 that likes small caps, that likes growth. And frankly, you don't need $1 billion on day one. You only need to raise 50 million, and we'll get that easily. So don't let it stop you. Start the engagement process and get that thinking cap on with your own executive team, but maybe with a very good advisor who is prepared to walk that long road with you and takes a growth journey with you from the start.
So I think Billy, Chris, Sam, Andres, you guys all summarized it very well. I'm not going to add much, or for redundancy's sake, just repeat what you said. What I will say is, so one of the great long-term investors that I think is always worth contemplating reading their work is actually Peter Lynch out of the States. And he, interesting enough, invested predominantly in the small cap space. He had a saying that I'm going to invert for the audience, and his saying was, one should never invest in the business that you cannot invest. You cannot explain that business's investment case with a crayon to a 5-year-old. In contemplating building up to a listing, part of understanding your business and being able to pitch it to the investment community is being able to have clarity on exactly what it is. What is the process? What is the repeatable process defended by competitive advantages and barriers to entries? And what is the market that you're going for? See, a good way. And like I said, I'm going to invert Peter Lynch's expression, but yeah, think about, see if you can express your business model with a crayon, and see if a 5-year-old will be able to understand it. In which case, if that still is a defendable, believable business plan and growth trajectory, the odds are, that the rest is actually just glorified tick boxes, and there will always be an appetite if you come to the market with a well-priced script.
Well, just from our side, I want to thank you, say thank you to the panelists. Thank you for sharing your insights. Thank you for your time. Thank you to the audience, of course. I think we can expect a sellout of crayons and paper shortly. So thank you all. We will circulate the recordings, and enjoy the rest of your day.